Hi there, accountants. I hope all is well, and I pray that as you're viewing this video that you're in the best of health and spirit. This video will cover Chapter 9, Analysis and Recording of Adjusting Entries in a QuickBooks Online for Accounting, 7th edition. Upon completion of this chapter, the student will be able to do the following: prepare an unadjusted trial balance and make adjusting entries for the following: prepaid expenses, accrued expenses, unearned revenue, accrued revenue, and depreciation expense. In Chapter 8, we added a budget, a profit and loss budget report, and a bank reconciliation to our Wild Water Sports Company. In this chapter, we'll add adjusting journal entries, and at the end of the chapter, you'll perform similar tasks assigned by your instructor. Prior to the creation of periodic financial statements, generally accepted accounting principles, referred to as GAAP, requires that accounting records are adjusted to reflect accrual accounting. So one key thing to keep in mind as an accountant, you should definitely understand the difference between the cash method of accounting in the accrual method of accounting. So under the cash method of accounting, what that simply means is that income is only recorded when it is received and expenses are only recorded when they are paid. On the other hand, accrual accounting, as it relates to income and expenses, it doesn't matter when the income is received. It doesn't matter when the customer pays. The key thing under GAAP is, was the revenue earned? And what that simply means is, as it relates to revenue, was the service provided to the customer, or was the product received by the customer? In such case, doesn't matter if they paid or not. The key thing is that the revenue was earned, therefore revenue must be recorded. Likewise, as it relates to expenses, the key thing is, was the expense incurred? Did we use up the phone bill? Did we receive insurance coverage for the month? If so, then the expense needs to be recorded. Doesn't matter when the payment takes place. So this process ensures that revenues are recorded in the period in which they were earned, and that our expenses are recorded in the period in which they were consumed or incurred. In this process, expenses will be matched in the same period to the revenues generated from incurring those expenses. There are 5 types of adjusting entries. Expenses paid prior to being consumed should be deferred. An example of these would be supplies, rent, insurance, etc., and they would be recorded as assets. So the supplies asset, prepaid rent, prepaid insurance, etc., until they are consumed. So to defer, that basically means to postpone, to delay. Expenses that are incurred prior to being paid, such as payroll, rent, utilities, etc., those need to be recorded and accrued as a liability because we are liable. We have an obligation to pay. To accrue, that basically means to increase. Revenue that's collected prior to being earned must be deferred. Sales, services, etc., until they are actually earned. So any revenues, any cash that's received from the customers in advance, those must be recorded as a receivable. So in the event, again, there's 2 distinctions. If a customer pays us in advance, we have a liability. It's unearned revenue. We owe the customer a service. Revenue that we earn prior to it being collected, that would be essentially accounts receivable. We are waiting for the customer to pay us, so we've accrued a receivable. Lastly, we have fixed assets, buildings, furniture, equipment, vehicles, etc. Those must be depreciated over their useful life to match the costs with revenues. In this section, we will create a trial balance before adjusting entries. We have to analyze them in light of the end of the period business events to determine the required adjusting entries. So I already have my internet browser open. I already have my QuickBooks online account in the Wild Water Sports Company open. Navigation bar is already open. So it's asking me to click reports from the navigation bar. So I click reports. I already have my custom reports open. We click trial balance, and it's asking us to look at the trial balance as of January 31st. How do we know? We see here as of January 31st, 2027. So I'll update the time period. And here we see for the trial balance, I'm going to make this a little bigger. So we see for the trial balance, we see the total debits and credits equals $751,009.66. So you always want to make sure, first and foremost, that the total debits and credits tie. But in addition to that, you want to go through each account line by line to make sure that the account amounts are correct, because just because the total debits and credits tie does not necessarily mean that the balances in the accounts are correct. So just keep that in mind. We move on to the adjusting journal entries, prepaid expenses. So after further investigation of the trial balance and period end, business activities indicate that $500 of the vehicle, gas, and fuel were recorded as an expense, but should have been deferred as a supplies asset until it's consumed sometime in the future. Thus, we need to record an adjusting entry. So we continue from where we left off. It's asking us to click new from our navigation. So I'll reopen the navigation bar, select new, and click journal entry under other. The date would be January 1st. So 01 or January 31st rather, 2027. And then we accept as the journal number. So we have journal number 6. The first thing we need to do is type supplies, asset in line 1. So we type in supplies, and then we we will input, supplies, asset. So we're creating a brand new account. So we'll create supplies asset. And then this is how we are essentially going to add it. So supplies asset, here we are. And then now we scroll down. This is going to be an other current asset in our account type. And then in our detail type, this would also be other current assets. And then we click save and close. And from there, we type $500 in the debits column of line 1. And then next, we select vehicle, gas, and fuel. So you have two options. You can either, pull down a drop-down box, scroll down, or you can type it in, either or. I prefer to type it. It's much faster. So vehicle, gas, and fuel. And then we accept the $500. We'll see that the 500 automatically populates. So we accept the $500, and then we press tab. And then we compare the entry to make sure it ties. So we have journal entry number 6. The date is January 31st, 2027. Journal number 6, we debited the supplies asset account for $500 and credited vehicle expenses, vehicle, gas, and fuel for $500. So we select save and close. And here it states that the same process could be used to defer a cost that had been recorded as an expense, but should be deferred as an asset at period end. So some examples might include insurance that needs to be deferred as either prepaid insurance or prepaid expenses, or rent to be deferred as either prepaid rent or prepaid expenses. Another example of this occurs when an expense is deferred in a prior period, but it's consumed or expired in the current period. So in such case, we would use the prepaid expenses created as an example, assuming that $1,000 of the prepaid expenses, in this case, the insurance cost that's paid to Allstate for future coverage, were consumed in the month, leaving $16,500 of prepaid expenses as an asset. So to record an adjusting journal entry to record the expiration of prepaid expenses insurance, we'll do the following. So quickly, just to reiterate, to ensure you understand, let's say you prepay for insurance coverage, and just to make it easy, let's say you paid $1,200 on January 1st of the year. It's $100 per month. What happens is that with each month that passes, you now need to decrease the balance of that prepaid asset by $100. That way, once you get to month 12, December 31st, the balance in that prepaid expense account should be 0. So we click new, then we click journal entry under other. The date is already there, so we accept January 31st as the date, and journal number 7 as the number for the journal entry. We select insurance. Again, you can drop down or you can type it in as I'm doing. So insurance. And then here, there's already an expense account in the company of chart of accounts, so we don't need to, input again. Just keep in mind, there are some sub accounts for insurance, but again, we're using the parent account insurance. We type 1,000 in the debit column of line 1. And then from there, we select prepaid expense, or type it in as I am doing, prepaid expense. We accept the $1,000, and this should be our journal entry number 7, the date January 31st. We debit insurance for 1,000 and credit prepaid expenses for 1,000. So we select save and close. And then once we close it, we see the trial balance that was created before. We now see that the trial balance has been updated to reflect the supplies asset account as shown. So we see that there's a supplies asset account with a balance of $500. Then we scroll to the bottom. Again, see, it ties, but the thing is that there were some differences. The amounts were shifted. So now our prepaid expense balance is $16,005 and our supplies asset account is $500. It's asking us to click the supplies asset $500 amount to reveal the transaction report. So we click on it. And here we see journal entry number 6, supplies asset for the amount 500. We scroll down and it's asking us to click back to summary report to return to the trial balance. And it's asking us to do the same thing for the prepaid expense account. Select it. And then it reveals the transaction report for the prepaid expense account. And as we see, the first entry deferred $500 from the vehicle expense. And then a second entry recorded the expiration of insurance, reducing the prepaid expense account. In this section, we're going to focus on accrued expenses. So these are essentially expenses that were incurred. We just didn't pay for them yet. So think of it like a phone bill, right? You get the phone bill in the month of November, and they are essentially billing you for the prior month of October. So further investigation of the trial balance and period end business activities indicate that a bill for $2,500 was received and recorded in the next month for advertising consumed in the current month. Thus, an adjusting journal entry needs to be made to accrue this expense. For our purposes, we will create a new accrued liabilities account to keep track of these accruals and keep them separate from accounts payable. So we continue where we left off. We open the navigation bar, we select new, we click journal entry, we accept the date of January 31st, 2027, and the journal number 8 is already there. We select advertising and marketing from the drop-down list, and we type 2,500 into the debits column. So 2,500. And next, we type in accrued liabilities. So we select add new and we add accrued liabilities. The account type would be other current liabilities. And for the detail type, this would also be other current liabilities. So for the next step, we select save and close. And we accept the 2,500. So we compare the journal entry, make sure everything ties. Journal entry number 8, the date is January 31st, 2027. We debit advertising and marketing for 2,500 and credit accrued liabilities for 2,500. Next, it asks us to select save and close. And as we see closing the journal entry, it reveals the trial balance that we saw before. We go back to the summary report and it's asking us to click the accrued liabilities of 2,500. And this reveals the transaction report showing journal entry number 8. And we select back to the report summary and we return to the trial balance report. And as we can see, because there was an increase of 2,500 due to our accrued liabilities, there was an increase to our total debits and credits by the corresponding $2,500 amount. Now we'll move on to unearned revenue. Again, this is an example of where a customer pays us in advance before we performed any services. Further investigation of the trial balance and period end business activities indicate that the sale of a boat recorded on sales receipt 1001 for $55,000 to Southtown Water Sports had not been delivered, even though cash had been received. Thus, the revenue had not been earned. Delivery is expected to occur next month. Thus, this amount of revenue and related sales tax must be deferred and set up as an unearned revenue liability. So to record an adjusting journal entry to reflect the unearned revenue, we do the following. We continue from where we left off from the trial balance as of January 31st, 2027. We click the sales amount of $164,000. We click the sales receipt 1001. So we click this. And we note that this receipt recorded cash received of $55,145. So here we see the difference. $52,000 is the amount of the Malibu Sportster LX, and $3,145 represents the sales tax payable. So we select it, we close it. And next is asking us to click new. We're going to create a new journal entry. So new journal entry under other, we accept the date and we accept the journal number. And the first thing we're going to do is we're going to select sales. And we're going to type $52,000 in the debit column. So key thing, especially when you are dealing with accounting, you need to have a solidified understanding of the rules of debits and credits. So when there's revenue, if there's an increase to revenue, then we are going to credit it. When there is a decrease to revenue, we debit it. So we just debited the amount. So obviously, because we didn't earn it, we want to remove it from the sales account. So we debited the $52,000. In the name, we select Southtown Water Sports. And then next, we want to create a new account. We need to account for this liability. So we create unearned revenue, and we add this account. This is a current liability or other current liability, rather, detailed type, same thing, other current liability. We select save and close. Oh, I actually need to update this. So I'm going to duplicate the tab. I moved a little too quick. So I'll show you guys how I fix my error. So we'll go to transactions, chart of accounts. I'm going to update this unearned revenue account. Unearned. Okay, perfect. Here we go. All right, so unearned revenue, just saw it. Here we go. So edit. And I'm going to change the detail type to deferred revenue. So I moved too fast. The account type should be other current liabilities and the detail type should be deferred revenue. So I fixed that. So we select save. Perfect. All right. So we go back. Well, the journal entry is already here. All right. I just duplicated the tab. So I'm going to close out of this. So we debited sales for $52,000 to decrease it. We didn't earn the $52,000, and instead we set up a liability account because we did not earn the revenue. So we select Southwestern or Southtown rather Water Sports. This is our journal entry number 9, date of January 31st, 2027, debit sales, credit unearned revenue, input the name. And then we click save and close. So closing the journal entry, it's going to reveal the trial balance that we created before. And then we go back to our summary report and we see that now our sales account only shows $112,000. And we see that there's this unearned revenue account of $52,000. So we click the $52,000 from unearned revenue and it reveals the transaction report. Now we click back to the report summary and we return to the trial balance. Now we'll focus on accruing revenue. So this is essentially where we performed the service for the client, we sold the product, and now we're waiting for them to pay us. So we need to set up an accounts receivable. Further investigation of this trial balance and period end business activities indicates that a TIG 25ZX boat was sold and delivered to a new customer, High Flyer Sports, on January 31st, 27, on net 30 terms, but not invoiced until next month. Sales tax on that sale amounted to $13,525, and the boat was sold for $225,000. Thus, we'll need to record an adjusting entry to accrue revenue and an accrued receivable. So we continue where we left off. We open the navigation pane, select new journal entry under other. We accept January 31st as the date and journal number 10 as the journal entry number. We type in accrued receivable. And this is a new account, so we will add it. We would select other current asset. And then for the detail type, it would also be other current asset. And from there, we select save and close, and we debit $238,525. Next, we type High Flyer Sports. And this is a new customer, so we add new, save. And then from there, we select sales in line 2. But again, we're expecting to receive $238,525, but $225,000 represents the cost for the item, and the difference represents the sales tax. So we input the name again, and then in line 3, we input sales tax to pay because this is a liability. We need to pay this to the respective state. And then we'll type in the name again, High Flyer Sports. So we just want to double check, make sure everything ties. We have journal entry number 10. The date is correct, January 31st, 2027. We debit accrued receivable for $238,525. We credit sales for $225,000 and credit sales tax to pay for $13,525. We select save and close. So we close the journal entry and it should take us back to the trial balance, which it did. And now we click on the accrued receivable. It reveals the transaction report for journal entry number 10, where we accounted for the $225,000 of sales tax and the $13,000 of $225,000 for sales and the $13,000 for sales tax. So we click back to report summary. We move on to adjusting journal entries for depreciation. So further investigation of the trial balance and period end business activities indicates the company's fixed assets need to be depreciated for the month. Monthly depreciation for equipment and furniture is $1,000 and $250 respectively. Normally, the adjusting entry would debit depreciation expense and credit accumulated depreciation. However, the accounts set up in the chart of accounts need to be edited. Thus, we decide to change the account names first and then record the depreciation. So we continue where we left off. We click the gear icon. The gear icon is here to the top right. So we have two options. We can click on the gear icon, go to your company and select chart of accounts, or we could open the navigation pane, go to transactions, and then select chart of accounts. Another option, you can type in chart of accounts, and then you can jump to the chart of accounts. So just know that there's more than one way to navigate things in QuickBooks. So we get to the chart of accounts, and then from there, we click edit from the drop-down arrow next to the words view register on the depreciation line listed under furniture. So we scroll down. And again, another way you can do this is filter it by name. We can type in depreciation and find it that way. Or we basically just, scroll down, we look for the furniture. And then under the furniture, we select edit. And then for this, it already says accumulated depreciation. So we're pretty much good to go there. Here it's asking you. So if you have not done it, then you would need to type in accumulated depreciation. But again, accumulated depreciation is already here. And we know that the parent account is the furniture. So we're good to go there. We click save. And then we scroll down to the bottom of chart accounts to select edit from the drop down arrow next to the words run report on the depreciation line. So let's scroll down. And now this is referring to the expense of depreciation. So we go to our expenses. All right. And if you don't see it, again, we can always just input it. So we see depreciation. So here I just found it. It was under other expense. So we select edit. And then instead of it just being depreciation, I'm going to type in expense. And then we select save. So we edited that. So now we can go back to our navigation pane, select new journal entry under other. We accept the date. It's January 31st, 2027. We accept 11. We'll debit depreciation expense for $1,250. And then from there on line 2, we input accumulated depreciation under the equipment. So accumulated depreciation, which is a sub account of equipment, for $1,250, or well, here $1,000 is the amount it is saying. And then from there we select furniture accumulated depreciation. So accumulated depreciation, we see it says sub account of furniture, and then that would be $250. So we want to double check our journal entry. Journal entry number 11, the date is January 31st, 2027. We debit depreciation for $1,250 and is allocated, broken out as follows. Equipment accumulated depreciation is credited for $1,000, and furniture accumulated depreciation is credited for $250. So we select save and close. Now we click reports from the navigation bar. We're already in custom reports. From there, we select the trial balance. And this is as of January 31st, 2027. So we run the report. We scroll down. And then here we see there is a partial view of it. And again, we want to make sure everything ties, the 99, 3, 58, 88. And then we see there are some differences here. We see accumulated depreciation of 11,000. And then we see the furniture accumulated depreciation of $250. So those are the key differences that took place. Again, as you are going through this, you want to double check, make sure that the numbers tie. This is a partial view of the trial balance, so just keep that in mind. So this brings us to the end of chapter 9, which covered the analysis and recording of adjusting entries. In this chapter, we recorded adjusting entries to create accrual accounting-based records. And then the next chapter, we'll create financial statements and useful reports.